Super to be with you, Merlin. It's Hugh Agro from Revival Gold. I'm joined with John Mayer, our VP Development and Engineering, and Steve Priestmeyer, our VP Exploration. And of course, Revival Gold is advancing the Beartrack-Arnett Gold Project located in the western United States. We've just put out a PFS and an updated resource, and are happy to be with you today.
Hugh, thank you very much for the introduction. Good to see you again. John, Steve, good to have you too. A big bit of news that you put out, a pre-feasibility study, and you put out a resource update. Lots to get into, lots of detail to come away with. One of the things you lead with on the resource update, the increased resources, is you are now over 4 million ounces of gold combined in measured, indicated, and inferred. But crucially, you've grown the Heap Leach project up to almost 1 million ounces now. Could your comments first, perhaps, on the growth in the resource? Yeah,
this is second largest discovery of gold, new discovery of gold in the United States in the last decade. 4.6 million ounces. 2.4 million ounces of that in the measured and indicated category, as you've said, 2.2 million ounces of the inferred. But what's really exciting is the growth in measured and indicated for the first phase heap leach aspect of this project. We're up about 2.5 times to just about 1 million ounces of gold. And then, of course, our underground, which is where the next phase of the project comes from. We're now up to 900,000 ounces of gold. That's a 3 times increase from our prior resource just 1 year ago, and with a 1/3 increase in grade. So a lot of growth in resource from yesterday's announcement.
Are you still drilling? Are you still exploring at the moment? Have you got the rigs turning?
Steve, we're just about to get going on that, are we?
Yeah, we've got the rig on site. We'll be drilling tomorrow.
And will that be on the oxides? Around Haiti West to the northwest.
Yes, the focus this year will be on exploration, which is exciting because it's the first time we've really done exploration. Everything else has been focused on adding ounces to the resource. So we'll be drilling a variety of other targets on the Arnett side, trying to develop a pipeline, if you will, of projects that we can use to build the resource base as we go forward.
Sorry, when you say the Arnett side, is that the eastern splay, the eastern shear, or is it the western zone with the heap leach?
It's the western side with the heap leach, yes. Yeah.
Okay, thank you. So I always get confused between those two. I will come back to the geology, particularly of the heap leach ounces. That the market's really tough at the moment. Do you feel that the focus of the company is very much on bringing and advancing the heap leach project as a priority, rather than running with the twin goals of doing the heap leach project and doing the exploration on the kind of the bigger multi-million ounce resource?
Yeah, look, I think that's an astute observation. The benefit of the Revival Gold and the Beartrack-Arnett project, I think, is the flexibility that's embedded in that project. In the first instance, we don't need to do anything. We keep a low burn rate, and we allow ourselves to be flexible in the current market, spend wisely, finding cost of less than $6 an ounce in the ground, and G&A burn running at less than 2 million Canadian a year. So we have flexibility around market ups and downs. But embedded in the project is optionality as well. And as you've alluded to, we're marching forward with the Heap Leach project because it's low capital intensity, one of the lowest according to our numbers in the space, and it is something that we can leverage with existing infrastructure to advance on a low-risk basis. And I think that's a great way to march this company forward. We've got that exploration potential, and we can continue to grow for the larger mill phase of this project. But in the first instance, it's the heap leach, open pit heap leach that we're focused on, and the PFS is, of course, all focused on that.
Well, let's look at some of the numbers around that, because the PFS is for the restart. It's for a heap leach operation. You've got $109 million of pre-production capex and an all-in sustaining cost of $1,235, and you've given numbers at a kind of a midpoint at 1,800 gold, but the gold price is above 1,900, and so if I just let's just refer to the $1,900 gold numbers today. I'm sure that'll suit you fine, but it gives an NPV after tax on a 5% discount rate of $138 million. And a good kind of a healthy IRR of just under 30%, which is attractive. It's always good to see that IRR with starting with a 3. I know you've given the number as 29.5, but if you round it up, it starts with a 3. Perhaps John, tell me about that capex figure of $109 million. Just kind of break it down, and in particular, when do you start measuring that number?
Well, that is pre-production capital, Merlin, directly associated with the project. It's not a feasibility study, for instance, or our permitting costs. But I think what's most important, I'd like to comment on the capex, is as we're a restart. We're not a greenfield project, and what's important about that is things like, an access road that's construction and operational ready, power line out to site, an ADR plant and building that's already there. It means that most of our CapEx goes into things that are in our view, a lot less capital risk. It's because it's in a lot of mechanical equipment. So what you see, we're very heavy on our mining costs, mining equipment, mechanical equipment by way of our crushing circuits and our ore conveyance system, and then mechanical equipment that's needed inside the plant. So where we're not heavy, which is where we view the biggest risk to be on capital, is in earthworks and in pre-strip. So we're low in those areas, and those are higher risk areas. So we feel the capex is we're confident in the capex, and we've been able to keep control.
When you talk about risk, you're talking about kind of budget risk. So just the cost of it rising.
Yes.
There's also another element of risk as well in execution and kind of technical risk. So of the things that you've listed, it seems to me that the crushing circuit and the conveyance system have got the highest kind of execution or technical risk. Is that a fair comment?
I suppose you might say that. However, even a crushing circuit is very simple. It's a mobile crusher. It's a virtually off the shelf product. So it's not the previous operation used a stationary crusher. We've gone with a mobile just because of the convenience and the flexibility of that. And of course, that again is a pretty low risk piece of equipment in terms of capital overrun.
So it comes you kind of pre-bought, pre-made. It's not a large bit of civil engineering that you're required to build.
That's right. It's very simple. It essentially arrives at site on the back of a truck. And what you're really focused to do is prepare a foundation for that mobile equipment. So it's very simple by comparison to a stationary crushing circuit.
Yeah, just to jump in, Merlin, if you think about it from the point of view of a lender, and we're already engaged with various lenders on the potential for debt financing on this project. But if you look at it from a lender's point of view, first of all, we're in the Western United States, so this is a secure jurisdiction. Low risk of investment. Secondly, as John's pointing out, with this being movable mobile equipment, there isn't a lot of risk around us digging a hole or creating a road that can't be removed and reused or redeployed elsewhere. So from a bank's point of view, from a lender's point of view, this is low risk stuff. And finally, I'd say it's not like we're inventing something new here. This is not a special sauce. It comes off the back of a truck. Again, as John said, we're not inventing something new on this project because it's been used and it's been proven before. It's a process and an approach that's been proven. We don't have to worry about some strange chemistry set on a new process for this ore. This is something that's worked before, worked very well, and we're basing a lot of our PFS analysis on that past history and experience.
Let's talk about the chemistry kit, because I see in your presentation you talk about an average ore recovery of 62%, but that's a mix of mixed material, transition ore, oxide and sulfide material. You must get very different metallurgical recoveries from those three ore types. I'd love a bit more detail on that, please.
Sure, I could comment on that, Marlon. So, the material at Beartrack, which is the area that we start mining, it's quite similar in behavior to the previous material that was mined at Beartrack. We do have we're predominantly oxide. The project is predominantly oxide to the tune of about 80% of the material is oxide, and then 20% of that material is made up of about 15% transition, and then about 5% sulfide. So it's obviously the transition and sulfide materials that do bring the overall net recovery down. But the previous operation did also process all three of those materials. So this is not a stranger to this flow sheet or this process. And so it's very similar in that regard. Obviously, the Haiti deposit, however, is strongly oxidized to depth, and it's much more consistent metallurgical behavior when compared to those three different materials at Beartrack.
How much of the resource is at Haiti?
I think about 40% is Haiti and about 60% is Beartrack.
When you say it's much more strongly oxidized and it's got a kind of a more consistent metallurgical kind of characteristics or properties through it, what kind of recoveries do you expect from the Haiti oxides or the Arnett oxides, kind of as a general grouping?
We're currently projecting 86% recovery of the Haiti material.
Yeah, that's good. That's Steve, go and find more. Go and find more of that stuff, please.
Well, in fact, the news, it gets maybe a little bit better than that. Really, our crushing circuit is designed to mimic the Beartrack previous operation in terms of general overall crush size, because we know that that's worked, and our testing has verified that crush size is appropriate for Beartrack, which is where we start. But what our testing also showed us is that the Haiti material is relatively insensitive to crushing, and so there's a strong likelihood that we're probably crushing too fine for the Haiti material, and that we can back that off a bit, and that gives us opportunities to reduce OPEX and potentially increase throughput. So I think that we've got more work to do.
Just to get my head around this, when you were talking about the mobile crusher earlier, are you going to have two crushing systems, one at Beartrack and one at Arnett, or is it all the ore going to be trucked to a central crushing area near the plant?
It is, at the present time, that's what makes the most sense to basically have a centralized facility at Beartrack. What we do is, because we've got a mobile crusher, because, it can be moved pretty easily, we start with the crusher closer to the Beartrack area, kind of on that eastern side of the project. And then when we move over to Haiti, we move it about a mile to the west to get closer to the Arnett and drainage and the Haiti ore body, to reduce trucking from that side of things. So we do relocate the crusher after the first 5 years of operation.
Just in terms of, you've got an 8-year kind of mine life planned at the moment. Surely, I was just thinking while I'm thinking, if you know what I mean, thinking while I'm speaking. Presumably, you've put the starter pit where you get the greatest return. When I think of the lower recoveries from Beartrack, I probably haven't accounted for grade. So presumably the Beartrack pits are probably slightly higher grade, so you get more bang for your buck starting in the east rather than starting in the west.
That's right. We start with low strip ratio pits and grade. There's also the issues of the sustaining cost associated or with the capex associated with getting out to Haiti. It does require a new haul road, whereas we don't require new haul roads on the Beartrack side. So we do avoid some additional capex by starting at Beartrack as well. So it's a combination of things that make sense to start at Beartrack.
Well, I noticed in your PFS that the numbers are very consistent from the PEA, but the one big delta was the sustaining capex. I mean, because you've done a remarkable job of keeping your pre-production capex and kind of everything is pretty much kind of nailed down, which is remarkable given the inflation. But that delta comes through in the sustaining capex. It jumps from $61 to $100 million. Could you just kind of flesh that out, please?
Sure. I think that there's a couple of reasons. Of course, the devil's in the details, but mining equipment has increased in price, certainly, over the past several years. And so a big part of that sustaining capex is in the mining fleet. So you'll see that as the biggest component in the increase in sustaining capex. The other issue is, of course, when you do a PEA, you don't have detailed water balance, understand some of those things in as much detail as you do at a pre-feasibility level. And we do have a better understanding of the water balance, having completed a pretty comprehensive balance. And what we did need is some additional infrastructure, a new pond associated with Haiti. Those things creep in also to add additional sustaining capex. The haul road out to Haiti did also go up in price relative to the PEA. So those are the three big areas associated with that sustaining cap.
Hugh, when I spoke to you before this was published, kind of a month ago or so, you were a little bit cautious about the kind of the capex figures, but you must be pleased with what's actually come back here. It's kind of you were being very conservative in your thought process. Your comments, please.
Yeah, so I think this is illustrative of the team. We really try hard to manage our business in a conservative manner that we can deliver on, because we fully intend to put this operation, into production, and we want to deliver to our plans. So when it came to the PEA, you may remember 2020 we had 40% of our PEA capital cost in contingency and owner's costs, and that was because at a PEA level, you never can do the detail of engineering work and study work and costing that comes through in the PFS, but that there are going to be things that were unseen at the time. And I would say that, you roll forward to this PFS, the numbers are very consistent because we made allowance for the expectation that there would be things like a settlement pond required at Haiti that we hadn't thought about in the earlier PEA plan. And I'm mentioning all this because I think that rolls forward going to the future. John and the team have done an outstanding job of thinking in terms of how we're going to build this and doing this in a manner that's going to fit with, delivering to expectations. And the same thing on the exploration side. When we first came to this project, I think, Steve, you were thinking about something in the order of 2 or 3 million ounces. We delivered 3 million ounces in 2019, 2020 kind of time frame. We're at 4.6 million ounces now, and I bet you if we were to ask Steve where he thinks it is going to go, he'd give you a big number, but he's still holding something in reserve. This is a big project with a lot of potential.
Interesting. Now, when I wrote out my list of questions to ask you, a lot of the focus was going to be on exploring for ounces around Haiti, because I kind of thought that the oxide element of it, the kind of open pit nature of it, was going to be kind of a high margin, kind of easily recoverable ounce. Now that I understand the scheduling slightly better, in a sense, that takes away the urgency to explore for the oxides around Haiti, doesn't it not?
I would say no. That is our priority, because if you think about this, generating $40-50 million a year of free cash flow, that's more than our current market cap in 1 year. So if Steve and the exploration team can put another 2, 3, 4 years on the back end of the Heap Leach, when we've got such low capital intensity to get going in the first place, that all goes to the bottom line, and it can have a huge impact on the underlying value of the company. And we haven't even started to talk about the mill phase of this project and what we can do there.
Just remind me, so it's what's your kind of targeted resource that's going to be mined in this PFS?
Well, the resource, like currently as it stands, is 8 year life. If you want to know where we target, of course, we'd all like to see it bigger. And so when Hugh says that we don't really want to take our foot off the gas in terms of exploration, I think that's valid. I mean, I think we'd like to add a couple of years to the mine life. I'd like to see us add a couple of years. I don't think any of us feel that's going to be unreasonable to do. And I think you're going to see the numbers really shine if you can add some years to the mine life. We think the numbers look good now. I think they look a whole lot better with a 10 or 12 year mine life, and I think that is very much within our grasp.
And just if I kind of get my head around it, you're looking at producing 65,000 ounces per annum for 8 years, which is 520,000 ounces produced. And if you have a recovery of 62%, that's 800. It's just about 840,000 ounces of your kind of resource that gets mined. So you're saying,
Merlin, you're absolutely right. Sorry to cut you off here, but you're absolutely right. The resource right now is 1 million ounces. The mine plan of proven and probable that is in the PFS is about 850,000 ounces, of which we're producing about 525,000 ounces of gold. So you can see the leverage in this. To that existing mine plan, we already have a year or two of additional resource. And I think what John is saying, it's not going to be too difficult for us to go to 10-year mine life. Over the course of the next couple of years, I don't see that being a problem at all. And in fact, I think with some of the targets that I'm itching to have Steve talk to you about, we can get it out to perhaps a 12-year mine life. There's just open deposits, open targets, and the drilling's underway.
Well, I come back to something that you said earlier. You said that the discovery cost is at $6 an ounce, and even in this terrible gold market, you're valued at $8 an ounce. So it's still worth it. It's still worth finding ounces. So Steve, let's hear from you. Open pitable ounces, please. As many as possible in as short as time as possible. Where do you start?
Basically, we have targets that are at 3 different stages of advancement, if you will. We have targets that are in the immediate area of the current Haiti resource. We're going to test those to give us an idea what the expansion potential is in that area. And that's an important focus for us because mineralization is open both up dip and down dip, and we're going to be drilling in those areas this summer, and that will give us and that will guide us in next year's drilling to add ounces to the resource. We have other targets, for example, Roman's Trench, which has some historical RC drilling in it, and the indication of higher grades of oxidized material. We're going to be starting there. We're going to be drilling a few holes in there to test that, to see what that looks like, with the intention of being able to go in next year and start to move that forward as well. And then we have one target that is a conceptual target. It's an idea that we've put together from soil sampling, geophysics, and a variety of other things. And that's purely conceptual. We'll put a few holes into that. So the idea is to be able to move things forward at different stages, but all with the goal of adding leachable ounces to the resource.
Is that third target, is that covered? Is that why it's conceptual?
Well, it's partially covered. It's covered by metasedimentary rocks. So the target is a fault based on geophysics. We have a soil anomaly there. And then also the contact of the intrusive with the quartzites is sort of the target area, and that's not really exposed.
And is that the same kind of geological setting where the other oxides are found at Haiti West and at Roma's Trench?
All of the mineralization that we have identified to date at Arnett is located within the Arnett intrusive complex. This would be in the intrusive complex, but along what appears to be a brecciated contact with the Proterozoic quartzites. So it's sort of a hybrid target,
but with plenty of a good kind of fracture system and kind of space creation where precipitation may have occurred.
Yeah.
And weathering.
Yes, and if you just look at the footprint of the target, it's approximately equivalent to the footprint of the Haiti target. So it's a sizable target. If you combine the geophysics and the geochemistry, it's a sizable target.
All your exploration work is budget dependent. But presumably you've also got targets on the Beartrack trend and down to the south and at depth and kind of in between. Presumably you've got a kind of a priority list on that Beartrack trend as well.
Well, we know that the mineralization at Joss is open at depth and to the south. We know the mineralization is open at depth in other areas and to the north. The higher grades are on the southern end. The map you can see on the wall behind me is a recent map that came out from the Idaho Geological Survey. They have a slightly different interpretation of the geology than we had originally based on our geophysics. And that's opened up some new targets for us to the south, given us some new concepts to test. We'll be initiating that work now that the rain stopped and everything's dried out. We'll be doing some soil sampling in preparation to advance those targets. But there are some targets to the south that are quite compelling.
Around the kind of the rabbit areas.
Yes, that's right. In the rabbit area, from Joss to the south into the rabbit area.
And Merlin, just to add to that, if you think about the growth of the Joss zone, up 3 times with this resource update, the Joss and the South Pit Underground, these are prolific areas, right? It doesn't take a lot of drill holes to add a lot of ounces, and not just add ounces, but bring grade up, because as we add the density to the drilling, it improves our geological modeling and our ability to refine the underground model. And I want to emphasize that this is not narrow vein sort of stuff. This is 3 to 25 meters horizontal thickness in the resource. So obviously we've got a lot of interest from majors around that. And I think as things progress, we will definitely be doing more work in the Joss area and along the broader Beartrack trend to uncover that opportunity.
That's a good point that Hugh makes. Is that we have something like 30 drill holes from the south end of the South Pit down to the southern end of Joss. So the drilling is wide spaced, and there's a lot of room in there to refine the model and to expand the resource. I think it's important to understand that.
There's no doubting the geological potential. Hugh, what I'm kind of concerned about is how do you get the market's attention? Your market capitalization is $50 million. You've halved. The share price has halved in the last 4 months. What do you do apart from stress about it? What positive actions can you take?
Well, I think the first thing to do is to recognize that there's there's the market, there's the marginal trade in the shares, and there's what's going on more broadly with our discussions with corporates, strategic investors, long-term sources of capital, of which there are many. And I think those guys are very active. I mean, we've got a very active data room. We've just passed over an important milestone here with a new block model, a new resource, a new pre-feasibility study, and all the analysis that's behind that. And, you can bet your bottom dollar that we've got a lot of interested parties in that. So, yes, it's true that at the margin, in the retail market, in the summer, with continued Fed hiking in being the topical of the day, the marginal retail investor isn't there. But I'm telling you, the strategics are there, and they're looking around, trying to figure out how they're going to bolster their pipelines for the future. And they're making a lot of cash flow at $19.50 gold. They are running out of resources and reserves, and projects like this in a really good jurisdiction are precious. This is, as I mentioned on the outset, second largest new discovery of gold in the last decade. And by the way, we've done that in just 6 years, from 0 to 4.6 million ounces. So this is a special deposit. It's got a lot of potential, and I'm not at all concerned about the ability to fund exploration in the future or the pockets of capital out there that can come and assist. Yes, on the margin, our share price trades around, but the question is, are we delivering value for our shareholders? Are we adding to the exploration potential, de-risking the project? Do we have the flexibility to carry forward in a tough market? And I'd say the answer is yes to all those questions.
And yet, I think the one of the concerns about a kind of a junior or kind of exploration and development company is balance sheet, and perhaps the share price movement of the last 4 months was a combination of things, but included the fact that your cash balance was kind of low, and that maybe finding a way to take a strategic investment, maybe to do a kind of a project level deal which reduces some of your funding liabilities to get some kind of either reduced burden or reduce increased ability to meet the capital requirements, because your development pipeline it's production in 2028 with construction and commissioning ahead of that. It's quite a long way out. Would you agree that balance sheet strength is a kind of a critical factor in the near term?
Look, I don't disagree. We're an exploration and development company. We consume capital, and we'll need more of it. Current cash balance sits at about 4.5 million, which is sufficient to take us through our programs this year and into the start of next. So we will need more capital, but we've passed an important milestone here. I think there's lots of interest in the project. We do have 40% institutional shareholding. In fact, our last financing was done by a number of our existing shareholders and others. So I don't think this is going to be a situation where we run out of capital to continue to progress the project. The question is, how quickly can we move it forward? And that will depend on longer-term pools of capital. And yes, it's top on our minds to go out and bring that additional capital into play. I'll tell you, over the fall and into the start of this year, our share price was moving quite nicely. We did have a hiccup with one of the shareholders that acquired their shares through the acquisition of Yamana, that's Pan American, looking to liquidate all juniors in order to pay down debt that was associated with that Yamana purchase. They were in the market selling shares. That took us down. I suspect there's still a block of shares left from Pan American to go. But these are things that are short-term things, and I would say that more broadly, if we look at the universe of corporates and bigger pools of capital out there, we've got lots of alternatives. We've looked at a number of things in the past, and we continue to look going forward, always with a view to optimize returns for our equity investors, of which all three of us are a big and meaningful part.
Yeah, no, thank you. Really interesting. Just in terms of timelines, you've always been quite conservative in your timelines. Some people might kind of get a little bit spooked at kind of 5 years to production or 4.5 years to production, which is what that is. Is there any way that you can, if you're going to get the wind in the right direction, kind of compress that? Or is that timeline driven by a conservative take on permitting? Any ways to kind of bring that forward?
Yeah, look, I'd say it's a realistic outlook from where we stand right now. We're always looking to optimize and improve on our plans and our approach. I think you've got to put this into perspective, right? We're talking about a deposit in the western United States. If from a greenfield site or even from a brownfield site that's been closed, you're looking at permitting timelines that are 5 to 10 years. So in reality, this is actually a relatively low risk, relatively quick pace of moving to a construction decision and ultimately getting into production. it does take time. And it's all the more reason why I think you're going to see the majors and the intermediates, companies like even Barrick, who are today contemplating getting into the copper business because they can't find enough ounces to, replace reserves at a 20-year low in terms of their production, and scrambling to try and find ways to fill their cupboards, looking for projects like this one. And it's the case that society generally does not appreciate how long it takes to put these projects into production, and it makes them all the more scarce and all the more valuable.
Hugh, I completely agree. Thank you, gentlemen, all of you, for your time. It's been a fascinating session. I think we should stop it there. But I look forward to what we haven't talked about, Hugh, is the kind of the immediate plans of what you're going to be doing, how you're going to be taking it forward. Perhaps we can do another session in a few months, when you've got a bit more clarity, once the dust has settled on this PFS.
Thank you, Merlin.
Thank you.
Thanks.